Welcome everyone to the Kendall Report. It is Sunday night, getting ready to kick off a big week, I believe. A lot of things going on. Friday was exciting, pretty much was predicted to a large degree, and I'm working on a couple projects that I'm hoping to release this coming week. One of the projects we were hoping to be done by Friday looks like it's going to be into next week. Like anything, when you outsource things, that it just takes longer to get things done. But I do have some pretty exciting things going on. So let's get into tonight's video. Make sure you hit the like button. We should have 100 likes right now. Just click it right this second. Do that. Make sure you subscribe. Still trying to beat the YouTube algorithm, keeping me at 38,200 subscribers for a year after, I don't know, 250 videos and lots of views, but no subscribers, no new subscribers. I lost 22 last week. So very interesting. Anyway, subscribe, okay? All right, let's get into the details of what's going on here. And I think we're about to enter some pretty exciting times coming in the next several weeks. People are going, well, why? Well, I talked about this the other day, that March and April tend to be pretty good months of all the years. Throughout the year are pretty good months. I think there's about 6 or 8 months that have almost historical positive returns. Well, we're into that, but more importantly, this market sentiment, what you see out there. I mean, I'm trying to put this together. I turned on a podcast. I do this just to hear, and I was talking about this the other night. There's a lot of folks that have been around these markets for 15, 20 years. And most of them, I won't say all of them, I don't like the global label. Most of them have it completely wrong. Most of them think that these interest rates where we are right now are going to destroy the economy and nothing can work. It's just catastrophic. And I've been going on and on about this theme, but I want you folks to get it, because it is just not what is going to happen out of here. And I'm sticking to my guns pretty solid here. Markets aren't telling me I'm wrong. And as I mentioned, when the 10-year went over 4%, thought it'd come back in. I think there's a little more downside on the yields. I'll go through all that here in just a few minutes. But we're just looking at, I think, a scenario. The markets are going to want to rebound. They gave this thing every reason to go down over the last 3 weeks, and nothing happened. And like I said, they've got a whole lot of people short. Friday was a big short covering day. There was a lot of things going on, rumors talking about things going on with the zero option expirations. I'm going to cover that sometime in the next several days, because I don't think it has the effects that a lot of folks think it does. And typically, when you're looking at option expiration, there needs to be some settlement on the other side other than cash that is going to drive these markets. But I'll go into that on another time. I think it deserves some credit. I am considering, we have a lot going on this week. We have Powell speaking on Wednesday. And when that man talks, the markets go up. I don't care what he says. For the most part, they typically go up. And I don't think he's got any answers for anything that's going on out there. We've got employment numbers coming out. Let's just look at the econ stuff for a minute, and I'll come back into some of the commentary. Monday, factory orders, no big deal. Expected to be -2%. Tuesday, consumer credit, 17.58. A lot of talk on the street that this consumer credit is going up, and that means people are borrowing money and they're getting desperate. I think the opposite. I think the reason why this is going up is because people have more confidence that they're going to be able to pay things off, and they're going to go buy new TV sets and do whatever they want to do. And it appears that that's in my view, of what's going on with the economy. There just doesn't seem to be any stopping it. On Wednesday, we get ADP, expected to show 200. We get JOLTS, which is the job openings, 11 million openings out there. I don't think that's going to change very much. Not sure it means much. We also get the Fed Beige Book on Wednesday. But then it starts, we get into Thursday and we start to dig into building into the expectations of Friday. Thursday, we've got claims expect to be 195. They continue to be really good. Continuing claims are 1.655 last week. I don't see much change. The only numbers, and I haven't mentioned this for a while, is the two if we go over 2 million continuing claims, then maybe there's a sign of something going on. I made a little note to myself here. This ought to really stir you guys up a little bit. But the mass layoffs are actually bullish, okay? I've been around these markets a long time. You watch it, you get some company, things aren't going good, they lay off a whole bunch of people and their stock goes up. And this is mainly on the tech stocks. I see a lot of people just hammering on how all of these tech stock, all these big layoffs, and that means there's a recession coming. I'm going to say it again. I don't believe there's any recession coming. I don't think you'll see when I cover the interest rates tonight. I don't see what's going on with interest rates as detrimental to the economy at all. And certainly segments, and most of those segments already played out. I'll save it until we get there. But I think the mass layoffs and the leaning out of the workforce, especially in the tech side, because they really juiced it up when 2020 happened and we saw all this job creation. Everybody's working from home. Everybody could get a job. They were mostly on Reddit and trading markets, even though they were supposedly working from home. So that was pretty much what was going on from that standpoint. But I just want to kind of cover, because it's unemployment week, these tend to be good weeks. I don't think we're going to see any really weird numbers. It's expected to be unchanged, 3.4%. Jobs expect to be 20,000 new jobs. Now, we had a blowout number last month. There was some seasonal adjustments, all that stuff. I've talked to you folks about that in the past, these seasonal adjustments. But the bottom line is, as I've been saying, once these numbers come out, and the markets just forget about them. I remember, I think it was 2 Fridays ago, I said, everything, all these old reports, the Fed, all of these different reports are coming out, inflation, are in the rearview mirror. And no one cares about it anymore. No one's talking about those numbers that came out weeks ago. Markets just don't work that way. And market sentiment doesn't work that way as well. And, I've always said markets can't chew gum and walk at the same time. That's certainly the case right now. So it's going to be heavily focused on Powell's testimony on Wednesday, which should be an interesting day. As I mentioned a few minutes ago, I'm considering doing a live stream on Wednesday, old school wise, whether it'll be 3 hours or not, at least a couple hours maybe. I'll let you know on Tuesday night if that's happening. And I think it would, whenever Powell's hanging around, there's usually some pretty good market action. And one of the things I want to do in a live stream is show you how amazing these indicators are that are on TradingView that we're offering out, is because they're amazing and predictive, especially intraday, 5-minute hourly chart. I go through the hourly every night here. It's just incredible. On Friday, Thursday night's video to Friday, the algos were absolutely, those of you had those, I hope you caught these moves, because it was insane upside move on Friday. And all of that was set up on the previous night on Thursday night pre-Friday market. And it was all right there and predicted as perfectly as anything could be. So I can tell you I took advantage of it, and it's really something. I did talk a little bit, and I posted it on my Twitter account real quick, folks. The video, it was from a live stream on how to short Apple, and I put a video clip on the Twitter. So I'm at Twitter, PortfolioXpert. There's no E in expert, so it's Portfolio, just an X, and then PERT is where you'll find me on Twitter. And there is a link there to that video. And we had the setup that I talked about the other day, where we got the outside reversal. Friday was a follow through. We should have 2, maybe 3 more days. I'll talk about that here in a few minutes as well. Just looking at my notes here, just to make sure I've covered everything that needs to be covered. It looks like the only other thing I would mention, and this is the irony / funny part for me, is everybody last week when we were trading at 3,900, I kept telling you, this is no big deal. The fact that we traded 3,900 doesn't mean anything. We may trade 3,900 again. I still think basically we're in a large trading range, and that's been 39.50, 40.50. We're back at 40.50 again. We'll see if we can get some numbers. I've got some interesting projections to show you here in a few minutes. But what's really interesting from my standpoint is that the markets right now, S&P up 5.4%, had a 1.9% plus week last week. The NASDAQ had 2.6. It's up 11.6 on the year. Russell up 2.0 last week, up 2%, and then up 9.5% for the year. So pretty good year so far, folks. You know, it's March. It's not only is it March, we're coming into March 6th. So this is a pretty good action starting off the year. I think a lot of recoveries. I built a portfolio in our PortfolioXpert with all those old meme stocks, and they got triggered right in January. That one of these portfolios is up 47% on the signals that came out of Wavetech. I put all the memes. I think there were 25 or 30 meme stocks in there, which were all the stuff that Kathy Wood crap and all the stuff that were getting hammered. That no offense to any of you millennials, but everything that millennials owned that we were out of, we got triggered back in coming in to January. And I think I looked at a portfolio earlier today. It's called Shit Stock Special or something like that. And it's up 47% this year. So there's a lot of these stocks. I haven't looked at what our my girlfriend Kathy has been doing. Let's see here. I'll just take a quick look here. Thought I had her on the screen. I do. She's at $40, so that's pretty good for Kathy to be over 35. But the point is that there's a lot of movement in stocks here, and there's been some crazy trades already this year. So as we come into this week, like I said, possibly doing something on Wednesday. We're trying to get a new program together that is going to help folks that are managing their own money to get some tools in your hands to really make a difference, especially 401ks and other things. So enough of that. Let's get into the database. I'm anxious to show you what is going on there. We'll start off with the short-term database, and as you may recall, we got down to about 33%. I said we needed to hold the 28%. We had some decent buying, 1,453 buy signals for tomorrow morning, 121 sells, so big bullish ratio. We're at 39.75 after tomorrow's opening. So we're seeing a little clawback. I would suspect if we can stay stable, just get a little bit of a bid continuing the next couple of days, we're likely to see this back into the 40 handle above 42% plus. And I think that will be something that you'll want to pay attention to if we get back above that number. Let's cruise over here to the weekly, because this is the big data that I'm really looking at here that is substantial. We have the intermediate database now at 68.92%. We have, if we look at all the sectors, we have 9 to 12 sectors long right now. We've got, of the industry groups, there's 102 industry groups. We got 66 of those long, and then we have symbols. We have total symbols of 15,790. We have 10,883, or 68.92%. In real terms here, folks, what this means is that 7 out of 10 stocks are long right now in our database, which like I said before, this isn't some simple number where it's above a 50-day or 200-day moving average. This means that it's been identified as a trending capability. Every one of our stocks in our database has a map that shows what they typically do on every trade. And I'll just go full screen here so I can talk about a couple things here. Over on the right-hand side, it may be a little small if you're not on a big device, but over here, we're looking here at the optimized weekly. Typically hold is a 205 days. Right now, we're in the duration right now, we're 37 days of 205. So there's at least rounding off 150 to 170 days looking forward. Those are market days. There's about 220 days in a year. So there's a lot of look forward here. Duration fulfilled right now is 18%. And typically they don't get to 100%, but they will get up to into around 70 to 78% is usually a max out on the holding period. So we're a long ways from that happening right now. And the average profit is 31% on those symbols. And then we're also looking at a standard deviation of 68. So 31 to 68%. These numbers are pretty elevated relative to if I went back 5 years, and looked at these numbers, they weren't it was probably in the 25% and maybe 48%. Now with all this volatility, these crazy trades that are coming out of these markets now, we're picking up these monster trades. And now like I said, the standard dev is at 68%. So it's 31.68, just a little bit over a double. And this is all within the context of these holding periods. So this is, as you folks know, unless this is your first time to this channel, you know, this data is what drives everything that keeps me looking at the markets from a bullish standpoint. That is what drives everything for me, because this data, because there's such a forward-looking scenario, and yes, I'm going to do it. I'm going to show you just a quick snapshot of the looking forward here. I'll just stay on screen. But basically, we are approaching a 72% peak in the database. And you can see the grade line in the background here should probably start to decline maybe in the next 2 to 3 weeks. Probably by the time we get through, we'll say by the time we get through March, maybe into early April, we'll start to see a peak in the percent bullish. We're right now 68%, so we could continue 72. I've seen it as high. If we go back to 2020, we did see this number get up into the 90 percentile range. I don't see that happening, but we could extend easily into 78 before we hit the peak, and that would take probably another 2-3 weeks. And that's why I'm referencing the end of this month, maybe coming into April, when we finally see a peak. The peak in the database, just to make this clear, does not mean a peak in the market. That is where the secondary, the stocks that came in pretty much from the beginning of the year, January, February, March, those trades that have went from around 38% up to this 68, 72% bullish, that second tranche of orders is what's going to drive the markets forward. All those trends are going to continue to go forward, and we see a rotation start to happen. And that's what you'll hear me in the next couple months talking about how the database is rotating. What's interesting, I've been watching this database. It's my creation, right? But I've been watching this database since 1996. So for almost 30 years, have been watching every movement on this database, and every day working with clients, working with our institutional clients for many years. And this is like this, I know this map so well, and that's why I'm trying to help you folks to utilize this information I have to help you guide some of your trades. Let's go ahead and get into the S&P. All right, here we go. interesting chart. This was really fun to watch on Friday. If you were playing into this big move that we had to the upside, the algos were literally, if you may recall, maybe not, but I'll remind you, is that on Thursday night's call, I was looking at coming into Friday, coming into London should have been a low of some sort. And that was exactly when the low was coming on. I was talking to some folks actually in Europe about when that was opening. And I was commented that, hey, this is right here is where you want to be buying. And that was the perfect time. We got an hourly reversal 1 hour after London opened, and the rest is history, as they say. And we went from the 39.85 level all the way up to 40.50. It was a really, really nice move. And this is a continuation move that's happening. Now, if we look at what the algos are telling us right now, what we're seeing here is that they're starting to cross over. PPM1 looks like it's going to cross over the second derivative. That tells us we should start to challenge this 10-period moving average, 40.43. And then the next level down is the 21. And this 21-period moving average is moving up quite substantially. So I'm going to stay on the hourly chart just for another minute here. I'm going to expand this out so you can see this. There are 3 fib targets on the downside. And right now, the fib target 3 is somewhat equal to where the 21-hour moving average is. 21-hour moving average right now is 40.17, and fib target 3 is 40.1862. We still have to, these numbers are expanding. The PPM2 is up 0.81, so the angle of attack is pretty huge here, and that's going to catch up. So we're probably going to end up around 40.25, 40.32 being major support overnight. Even though this algo looks like it's coming down real hard, what's likely to happen is we're going to run into the about 6-7 hours from now, long before the U.S. Open, we're going to run into some pretty major support. We should start to set up some upside here. I just want to show you a couple of things that happened, and I'm still working on the article I've been telling you folks about that I'm going to put on Substack. I put in some serious hours this weekend, and I walked out, said to my wife, I said, I have painted myself into a corner. This is a huge job, but it's a much bigger undertaking than I thought in trying to put this together. I spent almost 4 hours just putting examples together on graphics. You don't realize how much the creation of that takes. But we look at this number right here. We look at these numbers. The algos are just telling us that we're going to see some moderation. PPM for another couple hours. PPM1 is going to stay positive enough that we should hold above that number at 40.43. But the big number will be this 21 coming up under here. And probably fib target 1 is going to be a better target. 31, fib target 1 is 40.31. And then we're looking at 40.23 is probably extreme. In a minute, we'll go and take a look at the daily market grid, all that stuff. As always, I'll spend most of the time on the S&P just covering that on what these things are like to follow here. So let's go ahead and let's flip to the daily chart, which I think is interesting. Daily suggests that as we come into tomorrow, not Monday, but Tuesday, that we should start to see PPM1 start to cut through its second derivative. We're most likely going to challenge the 40.67 level. That number's coming down a little bit. It's probably right at 40.50. We'll look at the market grid for the daily and the weekly here in just a second. But as we look at right now on the daily, that's going to be your pivot level. The major support is way down at 4,000 even at the moment. That's your 10-period moving average. That's where this is indicating that we're about to turn up. But all the indicators are fairly flat. So let's go to the weekly, and then we'll come back and we'll do the market grid here. This is monthly, excuse me. Let me get this to weekly. So weekly, we got a couple things happening here, and I was talking about this last week. We traded under the 10-period moving average, but the algos have been very positive here for the last several weeks, predicting that we should see a rally. So we should get back to the 10-period moving average on a weekly. 40.22 is that number we come over right now. Like I said, we're trading 40.50 even right now, and we're staying above that upsloping line. Let me expand this just a little bit more so you can see it. So you can see this 10-period moving average right in here coming right up. The 21 is up. These two averages are going to drive this up, and what's being predicted by the algos on PPM3 is that the cyan line, or the 40, is going to start to turn up. So we are potentially entering into a new phase of this market, and I think this is where it starts to get interesting. And I'm just going to stick with the dailies, and I'll go over them. This is the weekly targets. I just want to talk about these weekly targets. It's been a while since I discussed this, but I'm really looking at a minimum right at the moment. I've got a couple notes here. Minimum for probably coming into this week, we could see a 41 handle, 41.33, and there's a short-term target at 42.16. These numbers here at these fib targets on the upside, 44.66 is the min fib target. That also ends up targeting similar highs. If we go back to August of last year, we got to 43.27. So we're likely to challenge this high in this pattern. And I believe what we're going to see here is at least a move to 44. We get kind of crazy numbers because all of a sudden we start looking at all-time new highs here in this pattern. And if you watched the video the other day when I went through all of the long-term aspects, really what I see here, and this is why the emphasis on the channel and everything, what I see when we go to the quarterly, I'm not going to do it tonight, but when we go to the quarterly and the monthly charts, we're looking like an upward bias here for the rest of this quarter and possibly going into Q2. This is what I've been advertising since January, is that we will stay positive probably into early Q3. We should see at least this 4,600 numbers are very, very likely in this pattern. The opportunity will be in that trade itself, which is a decent trade, right? That's a decent trade. But the opportunity will continue to be in these secondary stocks. I saw some folks in our live room chatting about that, and I'm going to get this project probably completed this week. I am waiting for a Bloomberg terminal. I got some other stuff that I'm working on right now, and I'm just trying to get everything lined up so I can do some really deep research. And I've got some really interesting things because these secondary stocks, and I believe what I've been telling you is true, and I'll just cover this right here at this moment. I believe this is what's true, is that you're going to see this whole onshoring situation is going to start to grow, and it's going to grow through corporate entities, not by government action. That's why it actually has validity. We've seen there's a fair amount of infrastructure deals going on. I live in Arizona. I think most of you know that. But I went down to Phoenix on Friday for a meeting, and on I-17, they're widening the road. And there's a company, if you don't know, it's Warren Buffett's best friend, Kiewit Construction, K-E-W-I-T. They built the whole interstate system going back all the way into the 60s. They've been around. They were the original contract. Their love affair with the governments, and whether state, national, these guys get the deal, okay? And so those monies, they're a private company, okay? They are not traded. And so the reality is that a lot of this kind of money, there's not any opportunity in government money because they're taking care of all their cronies. We know that, right? So the opportunity, I believe, on the onshoring will be much different, and it will have more visibility. I was talking to somebody in Brussels the other morning, and they were telling me that this is all the thing. Those of you in Europe, please comment on this if you will. It also helps the channel if you folks comment, especially on the replays. But if what I believe is happening, this is all the rage. And what's happening is nobody, I should say almost nobody wants to do business with China going forward. They want to bring supply chains back in. The opportunities are going to be on onshoring. It's going to be on logistics here, especially in every country. There should be structure. Maybe in Europe is a little different. I'm not as familiar with Europe as I am with the US, but this is going to be a thing, okay? And it's going to be a big thing, and it's probably going to be something that's going to have some real legs. And this is why when I come into the interest rates, I'm going to explain to you why these interest rates don't matter. 5%, 7%, they don't matter, okay? They matter, but they don't matter like most people think. They're not going to destroy the market. So all of this stuff is going to get priced. There's going to be a lot of money. There's going to be a lot of cash flow. There's a lot of good stuff ahead. If I'm right about this, and I believe I am, we don't have a lot of evidence because it's somewhat new, but we're starting to see some of these things. One of my favorite, I guess, idols, we'll call him, is Carl Icahn. And Carl Icahn's already started investing in some of this stuff. He's made a couple big plays. That guy is so brilliant. He's 3 or 4 steps ahead of everyone else. Some of this stuff, he made plays up to about 4 or 5 years ago. He saw this coming. And brilliant guy. So we're kind of at the beginning. We're still in the beginning of it, and I think this is going to be a big theme. Those are things that I'm going to start working on. Those of you that know about my ETF hacking, we're going to try to really dig into this thing really, really deep. And I'm hoping that sometime very soon. This is not something that we have to get done tomorrow. This is going to be a new trend that I believe will get traction. I'll just go on a little further rant here, because what really is happening here is very, very similar. If you went back, I think a good analogy is if you went back and looked at the steel companies when India and China started to expand right at the beginning around 2001, 02, in that range right there. We made a ton of money in the steel companies by focusing just on steel companies. Very similar to what we did when Warren Buffett sold out of all the airlines, and in 2020 when we made 100% in 8 months on the money just running a portfolio on there. Back in 2001, 2, and 3, there was about almost 190% made because of participating in that trend and that new building and expansion that was going on in India and China. So these things can get really, really big. And I think as we look forward, it's not anything about Great Reset, anything. It sort of kind of is, but everybody wants to have this back. I know I'm a little deep into this conversation, but everybody wants to try to get, I think a lot was learned from the last 3 years, and having your supply chains and having control over transportation, not being stuck with having boats stuck on containers in Long Beach or whatever port you're at, those type of things. I think everybody learned something from that. And this is a transition I think is going to take a while, and I think there's a huge play in there. At least that's my narrative that I'm putting out there. And this is why we're going to see a lot of this rotation. And I'm trying to tie something really big together here, is if we look at, when I was talking about the longer term, going through the quarterly charts, it looks like the quarterly charts not necessarily looking like we're just running off to new highs. There's just going to be this giant rotation. We're going to be stuck potentially in some sort of major large trading range. I won't define it off the cuff here, but large trading range. But what's going to be going on in that trading range is a lot of opportunity in areas like where I'm talking about. There's going to be a lot of industries. There's going to be some rotation and things like that go on. I did see a comment somebody made on Twitter, which I took to heart. I appreciate you guys be vocal. It really helps all of us a lot. But to start to focus in on some sectors and where the plays are going to be. So I'm going to be working on all of that going forward. And so this was, I think, hopefully it was a worthwhile rant. And I haven't even finished the S&P. It's a classic Bob thing. Boom! All of a sudden this happened. So mark this part of the video for you so you can see. So let's, yeah, and I just see somebody I'm looking at. Yeah, India's in this play as well, okay? India is a very, very big market. So there is so much. I will say this. I'll say the quiet part out loud, right? There is so much opportunity on this planet right now. I spent about an hour and a half talking to a good friend of mine in Switzerland last week, and by the time we got done, we had spent about $300 trillion looking forward in the next 10, 12 years. And there is just going to be a lot of investment in the planet. The world's not coming in. The climate's not going to kill us all. We're going to be here, and there's going to be a lot of opportunity. And I'd like to hang around and be with it as much as I can. But there is a lot of things to look forward to, and in this new, I would just call it as the world rotates. Not everything's going to be electric. There'll be a lot of that fossil fuel stuff around. It's going to be but it's going to be very interesting because it's going to take a lot to get that. And no one's ever broken down how much fossil fuels burnt to make one lithium battery. That would be an interesting thing to know. Anyway, all right, I'm done with that. Let's go ahead. Let's take a quick look at the grid and just see what we get there. So let's take a look at the market grid here. This is the daily grid. And let me get this up here so you can see it in this center section. So for today, we're looking at 4041. So S1 is 40. This is really strange. There we go. Something was wrong. Okay, now it's working. Okay, so S1 4034, S2 4016. That kind of puts us into those hourly numbers that I discussed. If you even remember that now, because I diverged so far from that. But the factors that are looking here, probably S1 and R2, which would be 4082. If we can get above that 65 number, this market will explode. Whether they can do it ahead of the things that are coming out this week, ahead of Wednesday Powell's testimony, whether we can do anything ahead of that, we may be able to. But this is for the day. I'm going to flip this over to a weekly here real quick. And we look at the weekly. R1 is 4081. So that becomes very real. R2 is 4116. I talked to you about target up at 4133 for this week. This is very, very likely here. R2, R3 is 4116, 4115, S1 4018. That's most likely be an S1. I would say an S1, R2. We'll see how that works out for this week. All right, so we'll start off with the NASDAQ. And I mean, we're saying this thing's exploding as we speak right now. It's up 52 handles right now. We just got a huge bounce off this 10-period moving average. And that's but here's the thing. It looks like this little spike up is going to be somewhat of the peak. There's a high target too. This is an hourly chart, by the way. And so I'm starting off just like I did with the S&P on the hourly. It says we're going to peak out. We're going to stay. This 10-period moving average is going to be the main support, 12,966. The low is 12,304, 12,296. And the low this last hour, 12,304, just above that number. And then we're just printed up to the high target 12,368 with a high of 12,378. So we just penetrated a little bit. The Fib target 3 now is 12,429. So let's go ahead and take a look at the daily. Daily's already challenging that 21-period moving average. And it's interesting because everything's very flat. I'm going to expand this just so we can see this pattern a little bit here. I can get this. I just want to look at this pattern here. We're trading right up to this 21-period moving average, 12,392, the high 12,378. So we're just right into that range. And we're looking at pretty substantial. We got the, as I mentioned, we did not have the outside reversal bar on the NASDAQ like we did on the S&P, but everything is starting to turn up. We should start to move and get above this 21, but I don't think that happens until we get through next couple of days. So this is the daily pattern here, a bit of a dragon head, which suggests that we're going to resolve to the upside and probably moving up into some retracement of some of these values. Over on the 16th of February, we printed a high of February there at, let me just get the number up here so I can tell you what that is. That was 12,792. So we're right now, like I said, we're 12,378. So I would suspect that we're going to trade up toward some of these highs that we printed in February and see if we can challenge some of those numbers. And this week looks like it's still setting up very, very positive here. All the flow seems to be heading to the upside. Let's move on to the Russell. Russell continues to look pretty good. We're getting the algos to turn up. We're looking at Tuesday, Wednesday. We should see the potential for us to trade into the Fib target 2 or 3. Right now, the high is 1936, 1938 is Fib target 1. Fib target 2 is 1962, 1978. This sets up that pattern I was talking about on the NASDAQ where we start to set a bit of a right shoulder up. Algos looking out usually within about 2 or 3 sessions is what these are really good for. But if we look out a few more, it still looks like everything's trying to roll up and that we're going to get a decent angle of attack and potentially start a new short-term trend on the upside here moving forward. All right, we'll go with the 10-year now. And I believe I'll go ahead and cover the dollar as we come into this week. I think it's possible that Powell says some things that the dollar is going to flatten out a little bit, but we'll go through the analysis here in just a few minutes. Let's take a look at the 10-year. One of the things that I was talking about, this is the daily chart in 10-year. Algos are suggesting we're still going to come down. We should challenge the 10-period moving average, 394. Below that's down to 380, but that number's probably really 384 on the downside. From that standpoint, we're really not seeing where there's any big acceleration. That accelerating pattern that was there has completed, and now we're trying to come into a correction. We should start to see things start to play off just a little bit. Let me go to the the futures on the 10-year, and we're breaking over the 10-period moving average. I recall talking about this on Thursday night. We're seeing the algo starting to move up. We should head up toward this 21-period moving average at 112, but it is declining. But it looks like 2 or 3 bars out that we're going to see the momentum, downward momentum on that burn off. So we're likely to get above that. The only number on this chart that means that I'm watching is this pivot number up here where these red dots are, and that's at 112.20. And if we can break above that number, then we'll get a pivot and we'll start to see yields. I'm not sure what that would equate to. That's probably about 380 on the 10-year. I'm not sure what the yield equivalent is on that. I don't have that chart in front of me, but it should be right around that. That would be, so if you do an inverse of this, that would be the market coming down. In fact, let me just put up the 10-year in yield. You'll see this. That would be the yield coming down to this 21 number, which right now is, like I said, 380. It's probably 384-ish. It should be where that lines up. So we should see some flattening here. And I actually think that if we get this type of action here, we're going to see this be somewhat of a positive for the market. And I'm going to cover the Dow next because I think this all ties together here as far as what's going on. So let's go ahead, take a look at the Dow. All right, so the Dow is looking fairly similar. We're breaking through the 10-period moving average right now. PPM1 is through its first second derivative. It looks like it wants to weaken just a little bit more, so it wants to roll over. Support here is going to be the 104.07 level. But what's interesting about this pattern is we do have some downward Fibonacci targets, which are valid right now. Fib target 1, 103.98. 103.45, 103.12. So we're looking at coming down to this 40-period moving average in this pattern, and that would probably set up a consolidation range. This is a daily chart, so let's flop over and take a look at the weekly chart real quick, just to get a feel for what this is looking like. And it was interesting. I had, if you notice these red dots up here, let me. I just want to make sure everybody is seeing the right thing here, is that let's take a look here, and just so you can see what's going on is this moving average right here is coming down. We're going to get sandwiched here, and then what we should see is a pattern that sets up like this. And if we get above this pivot right here, these dots, then once we get above that, then we're probably going to come back up. And that would tell us we're looking back at under 380, probably 375 on the yields, which will, that would really move things higher on when the interest rates move and the Dow starts to react to that. But it doesn't look like that's even a possibility here. So what's really coming out here is this point here is this is a rejection zone. We have the 40-period moving average. So if we did come here, we'd probably see a reaction back into a range. Whether we're going to get some big, let me erase some of this stuff so you can see it. Whether we're going to get like some kind of pattern here that would maybe, come down where we get a move like this, that would be pretty drastic. I think we just flatten out in this range here, and we get into a range bound situation from that standpoint, where we're just really just working in here, and we stay range bound, and then later we'll decide which way is which. And I think, I'm not even going to speculate. This is a weekly chart, but this is what should happen. We should see stability, but we should have a basic downside as we look at this. There'd be more downside action than anything else. Okay, next we'll cover crude oil. Crude oil looks interesting. I've been talking about it's stuck in this little range right here. What it looks like is we've got fib target 1 up here at 84 bucks. Been talking about this for a while. We're trading right on resistance right now at the 79.80. That's where the 21 period moving average is. I have something on there. These are, you'll see all these lines that faint in the background. These are what called the webs. They're all starting to turn up. So we're starting to get little mini trend coming in here. And, for the most part, all we've been seeing is, you can see the zigzag in the market grid. It's really been just a volatility range. But I believe this is the bottoming of this, and we'll start to move much higher in this pattern, at least coming up to the 40 period moving average. And fib target 1 here is 84, 89 is the range. And I think this 40 is going to hold it back. So we'll probably stay in this range. We're not going to get much out of it. From that standpoint, we should just continue to chop in here. And this is a weekly chart that we're looking at. All right, next we'll take a look at gold. Gold's continuing to rise along this 21 period moving average. It's up 0.55. PPM1 is still kind of upward slope. I think we still should challenge this 1875, 1885 range. I think we'll move up towards that. Last week, this was interesting. If we look at last week's action, the previous week we had a low of 1815, 1856. Last week we had a low of 1810, 1864. So we got an outside reversal bar at the bottom of the sequence, bouncing off the 21 period moving average with a positive 0.55 number. So that 3-day trade that I put on Twitter also plays out on a weekly. The bar increment is not very important. Otherwise, it will work on any time series. So in this case, a weekly. So if we close higher this week, we make a higher high. So we've got to trade above 1864. So far, we've had a high of 1862. So all we need to do is print higher above that. If we get up and test that 10 period moving average here on gold, and if you manage to close on Friday above 1854, that will confirm this, and we should get 2 more weeks of higher prices. And possibly, I was speculating last week that we'd see the market grid turn up. We did not get the grid flattened out. It didn't turn up. So it's going to take another week to get this pattern. But I think if we can get above that 10, that would be a positive. So this pattern that's setting up is starting to look like we might be able to get something interesting. I'm going to draw something in real quick here. I think it's worth spending just an extra minute here on gold. As what we could get here is kind of this 1-2 pattern and get a 3 to the upside, which then all of a sudden is targeting all-time new highs and over $2,000 and all that stuff. And that looks like a pretty good probability here. The only thing that's happening, if we look at the algos, they're just kind of flat here. So that's the speculation. If we go back and we take a look at what's more likely is we're probably going to see some kind of pattern like this. Moving averages start to turn up underneath here. Then we get a pattern, and we're looking weeks down the road, maybe into May or something, where we can start to see some challenges of these highs that were printed up here at, I'll have to get this, I have to take this off so I can get you a value here real quick. But the highs that were printed up here at 1975, that's going to be your key pivot. And we are weeks and weeks away from that happening. All right, our final market would be Bitcoin. I want to expand this pattern just a little bit here. This is the weekly, and we traded right down, I mentioned this, we traded right down to this 10-week moving average. That number is right now, let's bring that up. That number is at 22,187, the low 22,263. Pretty good support at that level. If we break below that level, then the levels that I mentioned last week are still valid, and we're looking at the 19.8 and we'll call it, let me read it the other way, 400 to 19,800. That's your major support. But right now, this positive move on the PPM1 suggests that there's less than a 10% probability to get below 22,188. So let's go over to the daily, just try to get a feel for what the patterns are looking like on a daily. And they just still, well, they came down into this range. Here were the Fibonacci targets that I talked about. They've been calculating since February 23rd, showing these downside, and PPMs were pointing to the downside. So we're finally gotten into those patterns. 21.5, the low, like I said, is 22,163. That's what, just 2 days ago, we actually printed a low of 22,000, almost down to that 21.5. So we've stabilized a little bit, but the downside pressure is still there. So there's a new Fib target one is 21.5, 2,500, and then 19. We'll call it, we're just going to call it 20,000 even. So 20,500 to 20,000 even is the bottom of this. And we'll see what sets up over the next couple of sessions. Okay, folks, that's going to do it. Looking at some of the, yeah, good idea. Smash the like button. Quite a few folks here for evening. Appreciate everybody showing up and hanging out with me. Just looking here at yeah, so I'm going to try to get a little more activity on Twitter over the next several days. I'm trying to organize a bunch of stuff just to keep everybody up to speed here. Thank you, Trader SLA. You're always promoting me. I appreciate it, and I agree with you, of course. But yeah, the indicators can be a game changer if you spend the time to do it. And hopefully, I'll get this article that I'm writing on the PPMs done. It is. I was talking to my buddy Jim Baker the other day, and I was telling him that, man, these exhibits and everything are just killing me trying to write this thing up. And so I think I decided that I'm going to do a video and see if I can convert the video language on how to explain what's going on. There's a lot of nuances with using the indicators, especially when you're trying to put a hard-coded methodology together. You have to understand that these are part of the indicators that are inside the trading models on Wavetech and on PortfolioXpert. And there's over 600 variables that are being done. So I'm trying to break them down to, here's some basics. I'm trying to get the Wavetech concept out there, which is a combination of PPMs, moving averages, and helping to kind of eliminate 70% of the garbage in Elliott Wave and just get you to the 30% that will help you get pointed in the right direction, which is all we really need. We don't need to know every finite situation and getting too intricate, because if you put 4 Elliott Wave guys in the same room, you probably have 4 different wave counts. What we did a long time ago was just try to normalize that so that we always had a consistent approach on what we believe. And it was PPMs, moving averages, a couple other factors. So hopefully I'll get this done. I thought it was going to be done 2 weeks ago. I'll be honest with you. I put in, I think, 7 hours yesterday. And I was just like, I wanted to cry when I was done, because I'm like, man, I'm still not done. I can't push this thing over the hump. And the bad news is part 3, this is part 2 of the article. Part 3 is even more complex and even harder, I think, is what I'm coming up with. I'm hoping that I can put the structure together. So just giving you folks a bit of an update there. So anyway, thanks again for watching. Appreciate it. We'll see you same time tomorrow night. And, and I'll let you know on Wednesday whether I'm going to do a live stream with Paul out. Sometimes it's fun. I really want to get the algos out, show you how this stuff really works. So it's pretty cool to see this stuff work live. Anyway, have a great evening, everyone. Good day trading tomorrow. See you tomorrow night.